Craig, how is all the volatility that's going on, not just in the stock market, but in the treasury market, affecting the supposedly placid muni market?
Supposedly placid, right? So that's interesting because a lot of investors view munis as their safe asset class, right? It's a stable price, very, very low default risk. But we are correlated to treasuries because we are a duration market. So we're a high quality duration market. So what we've seen is historic volatility in the muni market in the past few weeks with, prices of muni bonds moving, into the, 80s and 90 cents on the dollar for very, very stable double and triple A muni credits that have zero risk of default.
Is there any danger to the municipal bond tax exemption? Because we know the country needs money, and that's one way to get it.
There's always risk, right? It's not a 0% chance. I think that it's a low likelihood, especially now the way Congress is viewing the ability to get a budget done, to get the tax bill done, where they're looking at current policy versus current law, not to get into the weeds on that. But looking at it on current policy makes me less concerned about the tax exemption. And listen, I spent the first 6 years of my career at the Ways and Means Committee up in Albany. A lot of local politicians understand the value of the tax exemption to local governments and infrastructure in the U.S. And I know that they've made their members of Congress and the Senate very aware of what the ramifications of that would be.
So if that's a risk you're not too worried about, what are you concerned about when it comes to munis?
Munis are all about flows, and we're primarily a retail asset class, right? So I spent last week on the road, actually in upstate New York, meeting a lot of financial advisors, doing some panels with financial advisors to try and settle nerves, right? We want to make sure that just because there's volatility in the muni market, people don't make poor decisions and pull money at exactly the wrong time, right? Credit's very stable in munis. This is not a reflection of muni credit. It's a reflection of interest rate movements. And just because there's been a lot of price volatility, that's not the right time to take money out. So the biggest factor affecting munis is flows, people putting money in and people taking money out of the muni market.
So which types of munis do you like best? Do you like the GOs or the revenue bonds?
What I'm really looking at is just high quality, whether they're GOs, whether they're revenue bonds right now. You're looking at double and triple A bonds right now at almost 5%, right? That's almost an 8.5% after tax yield just at the federal level, not counting individual states like New York or California that are high tax states. So I really, really like high quality munis right now with yields approaching 5% on some of them. That's a tremendous value. And we haven't seen yields this high since 2011.
And you primarily like them in the state that you lived in because you get the triple tax benefit. Is it worth it now to go to another state considering all the concerns about things, even like government bonds?
Yeah, it depends. Depends on what state you're in. If you're in New York City, triple tax exempt New York bonds are extremely attractive. And in California, with the top tax rate being over 13%, extremely attractive. If you're in a lower or more moderate tax state, you might be able to find out-of-state bonds that have a better after-tax value for you. It's on a state-by-state, and there's a lot of calculators out there on the website. I know Eaton Vance, we have a calculator out there to help you to help you figure out if you should go in-state or out-of-state.
And then finally, one thing that befuddles a lot of fixed income investors is the best way to buy bonds, because you can buy a bond ETF, you can buy the individual bonds, you can buy mutual funds full of muni bonds. What's the best way to do it?
It's all individual, right? I would say there's certain times where you want an ETF. There's certain times where you want a mutual fund. There's certain times when you want separately managed accounts. I would say mutual funds get you invested today. And if you want to sell them, you get your money back basically the next day, right? You know the price in, you know the price out. ETFs, the same thing. You can take advantage of maybe some discounts or premiums that might happen in the market during volatility. A lot of financial advisors love ETFs now. And, people like SMAs strictly for long-term investors that are buy and hold, that are never really looking to liquidate. So there's basically three different flavors of munis, and each individual investor has their own preferences. When I spend time on the road, I run into financial advisors that each have their own preferences.
All right. Well, thanks for coming on and talking about it.
All right. You're welcome. Nice being here.